You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskins, your host as always. Today we are back talking with Anthony Morabito from Altegra Property Group, very much a leading commercial property real estate business in Western Australia. We only have experts on this show. Anthony, thank you very much for coming in again. We're going to be chatting more about commercial property, obviously.
Trent, great to be here again, mate.
Last time we chatted about a bit of an intro to commercial property, gives an idea of why would we invest in commercial property, what commercial property opportunities there might be. Today we're going to get deeper into the actual development of commercial property, because not only can we just buy existing sites, we can also develop those sites just like we would develop residential properties and rent them or sell them, right?
Yeah, correct. I think in the market with the current stock levels around investment grade commercial assets, there has been more of a focus from commercial property landowners to look at potentially unlocking or how they unlock extra value in their land, and one way to do that is obviously through developing that land, and commercial development has certainly been quite active in recent times.
Now with residential development, you've either got single story units, you've got family homes, you've got townhouses, and you've got apartments, right? They've got fairly similar metrics, especially the single story and townhouse development. But with commercial development, there are so many different sectors that determine the value of these things, but also, I guess, so many different sectors that have their own pathway to de-risking the development, which includes the different types of tenants that you'll get in, right?
Yeah, correct. And a lot of it does start with understanding the planning and zoning of that particular parcel of land. So the various councils throughout WA have their own town planning schemes that will dictate what type of premises you can operate from any particular part of land. Different
to the residential codes, right, where it's sort of R20, R30, R40. It's a next level of that, of can this be residential? Can this be commercial? If so, what type of commercial, right?
Absolutely. So there are various zones and planning schemes that will dictate that, and sometimes there's an opportunity to have a mixed-use development opportunity where you can collaborate with some commercial and residential on the same lot. Others are a bit more restrictive in, obviously, you've got industrial zone land where primarily that land is set aside for industrial development, and also in a retail sense there would be dedicated areas where you could only develop retail, and that sort of dictated by the planning schemes that councils put in place.
And that dictates the type of commercial development we would be looking at developing on that site. And obviously I think it'd be more of a reverse engineering of that. It'd be choosing the type of commercial development we want to do based on the industry we're interested in or the one we see the most opportunity, and then finding the site, right?
Correct. And through the economic period of the last 5 or 6 years, not every commercial sector has been performing to a point where it's enticing for developers to go and either develop on spec or try and pursue a tenant opportunity to develop a design and construct for that tenant. So a few of the sectors that we have been concentrating on are healthcare sectors, childcare and fuel. There's been solid interest from tenants even through WA's economic sort of period the last 5 years in those sectors where operators are actually wanting to either gain a foothold or expand their footprint within the Perth and WA markets.
Fuel is an interesting one. I feel like 10 years ago, petrol stations, they were a dying breed. They were turning into remediation sites where you'd have pool suppliers and nondescript commercial or even vacant blocks. And then it seems like in the last couple of years, they've come back in droves. You've got the Vibes, your 7-Elevens, these new brands that are just filling or refilling places that used to be an Ampol or a Caltex 15 years ago. What's going on?
Yeah.
Isn't fuel on the way out?
Fuel has been driven a lot by retail. So I think if you cast your mind back to 10, 15 years ago, your basic fuel station would be some pumps and a very small outlet where you just go and pay for your fuel. You
get in and out as fast as you can.
You might be able to buy a bag of ice or a loaf of bread or a pack of Chewies or a pack of smokes back in the day, but that was about it. What you've seen now is very much the operators that are operating significant sites. There's a focus on diesel now going into fuel sites as well as unleaded. But their retail offering is significantly enhanced from what we've seen sort of 10, 15 years ago. So retail outlets now for fuel, you're looking at sort of 250 to 300 square metre, potentially retail outlets. And if you speak to the operators, where they make their margin is in those retail outlets. So the fuel is very much the carrot, if you like, to get the patron in, but where they make their margin is very much so in that retail store.
And I guess that's the future, isn't it? Is they've pivoted away from trying to make money off of fuel. I remember one of my early jobs in a different life, one of my jobs was to analyse the profit levels that these, a Shell or a Caltex would make on fuel, and it was literally 1 or 2 cents a litre. Of all of that, they make 1 or 2 cents a litre. So they're not making it on that. They're making on the $5 Malteser packs. So the more space they have for more of that, and you can see they're creating, they're building in other brands, the Mug and Bean and the Foodery, all these different brands that they're bringing in to get people to not only come to a petrol station, but stay and spend more money and then, nick off later, as if every petrol station is a roadhouse nearly.
Correct. You've got cafe offerings, you've got pie face, you've got Krispy Kreme. So that's very much about coming to get the fuel, but also spending money within that retail shop.
So as a developer, we're not the operator, we're not the tenant, we're not the Mug and Bean, the BP, the Shell. We're the person who owns the building and we lease it out to them. What's our pathway, I guess, to finding a site, getting that zoned for what is, environmentally not the easiest thing to get zoned for, and then finding a tenant to be able to have the confidence to go through development approval and build this thing?
Yeah. So I think finding the site with the appropriate zoning is certainly the biggest challenge and hurdle that you need to overcome from the outset when looking to develop a fuel station. If the fuel station is located in a high traffic location with enough passing trade opportunity, and it's in a catchment where it's not saturated with competitor activity, that will generally lend itself to an operator considering that site as a design and construct tenant. So really capturing the zoning straight off the bat is probably the most important part. Once you've got that, there are a host of operators out there at the moment, and we're still seeing operators coming into the market, believe it or not, and sort of establishing a presence. There's a couple of operators at the moment based from South Australia who are about to put a foothold here in the WA market, and they see real opportunities for their offering to come in and disrupt the players that are already here. So there's certainly variety of tenants, and they're all offering something different, primarily through their retail offering.
How much sort of money do we need as a developer, the owner of this asset, to be able to buy the site and develop the site? Surely not a poor man's game.
No, and developing a fuel site can be quite costly, depending on the scale of that site. So there's been a trend in the last couple of years now with a lot of the fuel organisations looking to incorporate larger sites where they can facilitate diesel and large vehicles, so trucks and road trains, etc.
Future electric as well, I'm sure.
Yeah, I mean, electric is something that gets spoken about a lot when you talk about fuel. I'm still unsure as to how the current fuel stations make that leap into electric cars and what their value proposition will be when electric cars eventually do arrive en masse.
Well, my thought would be even more of a proposition, because it's going to take probably 15-20 minutes to fill one of these cars up with the juice, and then what are they doing in that time? They're probably hanging out at the cafe.
Yeah, correct. Yeah.
Back to the question, we're talking a couple of mil at least to buy the site, right? And then probably a couple mil at least more to develop the asset itself.
Correct, yeah. A lot of developing comes down to securing the land at the right price. So I think primarily your development cost for the built form is going to be consistent wherever it is, but identifying sites where you can actually acquire land at a reasonable cost so that you can actually maximise the developer profit and margin on completion is really the critical component to having that. Keeping in mind, these leases that you're signing with the fuel companies are typically around 12 to 15 years on an initial term plus options to extend thereafter. So they are one of the few asset classes where you can get a long-term lease out of the investment.
And when you compare that to term deposits these days, 6-7% starts to look pretty attractive to people, especially pension funds.
Yeah, and look, there's a lot of activity on the investment market with fuel stations. And so if you're looking as a developer to build and then sell on completion an established fuel station, I think valuers are typically looking at that at a sort of yield of around 6 to 6.5%, depending on the location and the operator. And that can be even tighter on the East Coast, but here in WA, typically the transactions we see for leased assets with good fuel operators are between that 6 and 6.5% return.
So the idea here would be to be able to build it just like in any residential development, recognise what the rent that the operator will pay, divide that out by maybe 6.5%. Maybe that comes to $4 million, right? If you can build it for $3 million, well, there's $1 million on the table for you.
Sounds simple.
Pretty much, the back of the envelope way.
Yep.
But that, I guess, we're about to speak about childcare and healthcare as well. Same formula, really, isn't it?
Absolutely. And sort of moving on to childcare as another asset class. So when you look at the lease terms, so sort of 12 to 15 years, I mean, that's an extended lease term for an investment to have a single tenant there and have a guaranteed return on your investment. So, I mean, childcare is one that offers that as well. The zoning requirements for childcare are a bit more straightforward than fuel, in that most residential areas, there will be an opportunity for childcare to go into those residential areas as a discretionary use under a lot of the council planning schemes.
Explain that.
So discretionary use basically means that the council can exercise their discretion as to whether they would accept that development in that particular area. And that will often be assessed based on what else is in the area, traffic impact, car parking requirements, and the like.
So I guess a little bit similar to if you had a split code, a dual density code, where at R20, it's a given you can develop that site at that density, but at R40, you have to meet XYZ criteria, and then we'll, at our discretion, approve a development at that density.
Yeah, correct. I think what we've seen as well is, going back 5-10 years, a lot of converted homes turned into childcare centres. So that's happened through the ability to be able to go into those residential areas and actually have a childcare centre operate within the residential zone. The trend over the last 5 years has been more heading towards purpose-built centres.
So knock down, rebuild.
Correct. And what you're seeing in that is that there's been a lot of activity from developers with established operators looking to, again, grow their footprint here in Perth and WA. So there's certainly been a massive spike in the number of centres and development activity in that childcare sector. And the quality of centres that you look at now compared to 10 years ago, there's an absolute remarkable difference in the quality of those centres. We're talking purpose-built, early learning type facilities.
They're very impressive. I've been through a few very recently, and I was expecting your sort of daycare where, ferry bread out for lunch and there's crap everywhere, and old, renovated houses, more of that daddy daycare sort of thing, right? But you're right, these are impressive, world-class, brand new facilities, most of them with specific hourly programs of how these children are taught, making specific things for these purposes to understand this aspect of the world. They're learning about marine animals today, and obviously it's at a 3-year-old level, but there's a curriculum, and every centre has a curriculum planner, as if it's a school, and they're building these to that level now, and I think that's because parents are expecting that as well. It's no longer a babysitting service, it's very much the precursor to school.
Yes, absolutely, and I think you've nailed it there. It's no longer just a babysitting service, so it is actually viewed now more mainstream that you put your kids into an early learning centre, and it's viewed as a good stepping stone for them moving into primary education. The other thing that has underpinned, or does still underpin, the sector is significant amount of government funding that's allocated to childcare. So obviously the federal government has a very generous, let's say, package that subsidises a significant portion of the daily childcare fee. This now makes it very accessible to most families to have 2 working parents and then have their kids in care and not have the onerous fees that go with having your kid or kids in care.
And that's the unique thing about the valuation of a childcare centre, right? Because the rest of the commercial, which is generally a per square metre rate, like a warehouse, for example, maybe $300 per square metre per year, and then that's your value, right? Your cap rate of 6%, and there's your value. With the childcare, it's not based on a per square metre rate. What's it based on?
So the rental methodology for childcare is based on a value per licensed place. So what that means is when a centre is built, or when an operator goes in to start operating a new centre, that centre is assessed and the operator is given a number of licensed places that they may have operating from that centre.
So how many kids you can have?
Absolutely, yeah. So that then really dictates their capacity as a centre, and the rent is attributed based on that number of places, and that's how you arrive at the annual rental figure.
And out of that annual rental figure, again, someone who might buy that place might be paying it at a 6.5% yield, might be valuing it at a 6.5% yield. There's your value. And if you're developing these sites, if you can get the planning side right, get the right tenant in, which would allow you to have a lower yield based on the de-risking of that long-term tenant, then if you can build it for less than what the 6.5% capitalisation rate would say the value is, then there's your profit line, right?
Certainly.
Same thing.
Yep. And there's been, again, a bit of a perfect storm of activity. We've had a lot of operator interest looking at Perth as an undersupplied market for quality childcare product.
Is it undersupplied?
In certain areas it still is. I think we've seen a lot of development happening in some of the emerging suburbs, so a lot of the greenfield suburbs.
Why is that? Why is it emerging? Is it just because it's easier for a developer to go in and build on yellow sand?
That's a factor. Availability of land supply is certainly one, but also operators acknowledging that their target market is generally young families, and you're looking at emerging residential areas. Typically, their target residents are young families. So there's been a sort of a perfect storm and marry up of those two scenarios.
But the ironic thing about this market is that where you expect where most of the young families are, which is true, out on the fringes, that's where the oversupply of operators is, and therefore what's happening is the occupancy rate of these places, the performance of these places financially, is far worse than the places where there is an undersupply closer to the city.
Correct. So as a developer, you'd really now be focusing your efforts in sort of the infill areas that we like to call them. So we're talking about established suburbs with a sort of target audience there of younger families, where you may be able to acquire a parcel of land or parcels of land, and you've already got an established catchment or trade option there for a potential tenant to come in and leverage from. And those areas typically will have less competition because historically, if they're built up, there's less available land supply for someone to go and actually build a new childcare centre. So the opportunities are more geared towards acquiring established premises and redeveloping those into purpose-built centres.
I guess that's where the opportunity is. If you can knock down and build a new centre which provides for that high-class performance where you're going to get all your parents wanting to go to, even if there are a few older repurposed houses around, that's where your opportunity is. And it's also where you can charge a higher fee per placement, I guess.
Yes, there's been an absolute, what we call, flight to quality for childcare, with more operators coming into the market and the level of sophistication increasing greatly. I think the expectation of parents now has changed in that you've got the government subsidy there underpinning a significant amount of your daily fee that you're paying to put that child into care. So then it becomes about you putting your child into the best available care, because as a parent you want to be doing the best for your child. That's just human nature. So if there's a $2 or $3 difference after subsidy of sending little Johnny to the old converted house down the road or to the brand new centre,
the better teachers or carers, they're going to be wanting to go to the nicer place to work as well, right?
Correct. So there's definitely the flight to quality that's happening there. And what's happened is, over the years, as the new centres have come online, they've now set the benchmark. And so that's why you're seeing the whole industry kind of being brought up to a standard that 5-10 years ago was certainly not there. So
it really reminds me of the residential unit market, where if you see new unit product, it sells easily, it sells well at a higher price. Stuff that's 5 to 10 years old, same square meterage, same services, but just depreciated, heavily discounted in price. It's same with the apartments, right?
Yep.
That seems to run similar in that commercial space with childcare.
I mean, markets are always evolving and changing. That's the beauty of evolution, I suppose, and that sector is going through an evolution at the moment in terms of the expectation, and it's very mainstream now. So it's no longer a it's not a niche. Yeah, so it's again two working parents to sustain a household. It's quite common to put kids into daycare.
Well, and the more women that enter the workforce, I think the more likely, especially in the inner suburbs where more professional women, I guess, would be working close to the city, the more demand there's going to be for these higher quality places. And when more parents realise that it's not just a babysitting service anymore, it's actually probably a learning centre that has a better capacity than possibly the mum to teach these kids, because they're trained to do so. You might find, I would have thought there'd be ongoing higher uptake as a percentage in the urban infill areas as well.
Yeah, and from a property investment point of view, the fact that you've got a significant amount of government money backing a lot of these centres by way of the grants and the subsidies, gives investors a lot of security and a feeling of security that that industry is a strong one that they're happy to invest in, because they are very much purpose-built facilities. So it's not like if that tenant was to move out at the end of their lease, you can just go and lease it out as an office. If you develop a childcare centre, you've got a childcare centre. So the fact that there's government money underpinning that certainly gives investors and developers a lot of security and that there's longevity in the industry.
Finally, and probably more briefly, healthcare. Explain that and how that compares to the last two commercial types of developments that we've just spoken about.
Yeah, so certainly healthcare as an industry is what we call, we'll never say anything's recession-proof, but we've got an ageing population and a growing population where the requirement for healthcare services is growing.
Give us an example of a healthcare commercial property.
Look, in a simple form, medical centres, physios, psychologists, research and development type opportunities or tenants. So allied health centres can incorporate all of those into one building, or you may look at just developing a medical centre for a medical group and then have the pharmacy sitting off to the side of that. So medical centres have been a popular development asset class over the last 6 or 7 years, and that's tapered off more so in the last couple of years due to some changes in government regulation around doctors being able to come in from overseas and work within the metropolitan area in Perth. The challenge now there is that there is a shortage of doctors and GPs locally, and with the government restricting movements from overseas trained doctors to come work in Perth, that's restricting the new development opportunities for
as in the demand
centres.
For new centres,
Yeah,
because you've got less doctors demanding rooms.
Correct, and a lot of the problem therein is that a doctor may go and open a new medical centre, but not necessarily be able to staff it with enough GPs to meet perceived demand in that area. So what you've seen is them just hold back on doing anything new.
It's consolidated into the existing centres.
Yeah, correct. So that's a sector where I think it's going. There's still some change to play out, and I think as we see the population growth reignite, hopefully over the next few years, I think that's something that will probably need to be looked at to be able to bring in the overseas trained doctors.
And how are they paying for their rent? Square meterage?
It's a square metre rate, yeah. Yep.
And I guess that is just very much related to the location, rather than the service itself.
Yeah, location specific there, and I mean, in putting these developments together, one of the benefits, they're often seen as blue chip developments because you've got a secure tenant, very long lease term, typically 10-year lease if you're looking to develop a medical centre. So it's a very solid lease term, and in terms of the way they're viewed from the valuations industry, it's very strong in terms of your yield that they'll look at given the profile of the tenant.
Is it any more expensive to develop a medical room, a healthcare room, than it is retail space?
Look, it'll come back to what you're incorporating into that design and construct. So if you're purely providing a base building, there's really not a lot of difference between building a medical centre and building a set of offices. There is some infrastructure that goes in under the slab, which incurs a nominal cost. But essentially, building a medical centre without the internal fit-out is an office building.
There you have it, guys. 3 different types of commercial developments that we've spoken about today. Fuel, childcare, and healthcare. All 3 that are quite prevalent and we believe are going to continue to be prevalent in certain, especially infill areas of Perth. I thought it was just a good idea after a lot of conversation about residential development over the last couple of years to start getting to a new level of thought process here, especially for our listeners with a bit more in the back pocket about what they can do with their cash on a development space in commercial. Anthony, thank you very much for coming in again, mate. It's been really, really interesting, even from my side, learning more and more as I go along my property journey to understand the opportunities I've got as a developer, and not only just in what I do every day in the residential space, but moving into things like childcare and healthcare in the future too.
Thanks, Trent. It's been good to talk to you again.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!